Good morning, this is Ken Long from Tortoise Capital with a quick review of the rules for the index channeling system for our swing trade course. The first thing I want to do is start with a quick picture of what it looks like and to describe visually what we're looking for. Here's an example of channeling from 20 September 2012. We did this one at a workshop and framed it for the next day. So essentially what we're looking for is price greater than the 200-day moving average so that it's a bull market, and we're looking for an orderly pullback to oversold conditions on Williams percent R. And when we get that, we buy tomorrow's open mechanically. Now the choices for entry are buying today's close and absorbing tomorrow's risk, buying tomorrow's open, or waiting for a mechanical entry where price we hope opens in an orderly manner inside the real body, and then we enter when it takes out yesterday's high, or looking for an hourly breakout in a similar fashion as the triple screen. All of those are reasonable approximations of the system. The mechanical system that we brief with the stats is buying tomorrow's open because we think that's fair for someone that's not looking to hang around during the day to improve your entry, or who doesn't want to take the overnight risk, or who can't buy the close of business price or right at the close because you've got work. And so the reasonable mechanical entry is tomorrow morning's open, and so that's the primary entry for briefing purposes. It's a perfectly satisfactory way of trading the system. So again, all we need to see is bull market. It's better than this 200-day moving average. It has pulled back in an orderly fashion to oversold on Williams percent R10, meaning it's below -80. We simply buy tomorrow's open, and then we're waiting for it to resume its natural course, and the exit is when price gets above -30 on Williams percent R. It is now corrected, and then we sell the next day's close. This is a long only system, cannot go short. You could elect to add the sideways area as an area not to take the trade. You might insist on price being better than 2% above the 200-day moving average rather than above the 200-day moving average. When we first built this, we just used the simplest market classification of all, and it trades satisfactorily in that way. So you'll see those choices outlined in the paper on the system's definition. So let's get back to the rules. So the rules are straightforward. Rule number one is that today's close is better than the 200-day simple moving average, so we want to be trading with the dominant long-term trend. Rule number two, we want to buy when today's close is less than -80 on Williams percent R10, meaning that we have a price that is pulled back away from the main trend. Point three, rule three, we want to buy at the close or in tomorrow's opening, and as I just briefed, we want to buy tomorrow's opening because that's fair. There is a slight performance improvement if you can buy the close, because quite often that is seen as a value moment, and then in the overnight trade, people start bidding it up because they want to buy quality at fair value or on sale before it gets to fair value, and so price opens with a gap up and then continues back to revert to the mean, and so we lose some of that overnight trade. So either way will work just fine. Now if you're still in the trade and you get another setup condition and it repeats itself before you get the exit, you can buy a second unit, and the exit is when today's close is greater than -30 on Williams percent R. You've caught that overreaction or that sell-off. It has snapped back towards the fair value, and then you sell the next morning. The window of opportunity is over, and so we're using again Williams percent R as a measure of short-term overbought and oversold. Here's an example from early in our trading practice of what that looks like. This is about 6 months in the Qs. This is nothing unusual about this. This is the 200-day moving average right here in the sea of red, or the lava, and so we can buy, and that's so oversold, overbought, oversold. That crosses above minus 30 up in here. You miss all of this move, this continuation pattern, so it's important to know what this system will get and not get. So it really is getting these oscillations in a generally upward trending market. So 2 signals to entry. For entry, this did not get above minus 30, so it came back into oversold conditions here. And then cash, again, you miss this move. You get the oversold conditions above minus 30. 2 signals and a sell, 2 signals and a sell, buy and sell, buy, and then you would, maybe I'll show the exit on this one. But there we are. So that's what 6 months in the NASDAQ 100 just happened to look like from our trading practice a few years ago. So a relatively straightforward system. Let's take a look at how this works with market classification. Because of the rule set, you can only get into channeling, ETF channeling, when price is in a bull condition. You could elect not to take it in the sideways condition if you wanted to refine the rule set so that it had to be more than 2% higher than the 200-day moving average. Performance when it's down in this area will tend to kind of peter out anyway, and so I don't have any problem with you electing to improve or tighten up the rule set a little bit more. When we were trading it, as long as it was above the 200-day moving average, it was fine. And when I said when we were trading it mechanically in the early 2000s, middle 2000s. So again, a robust rule set. Let's take a look at the performance numbers on it over the mechanical test period when we're trading it forward, that is. Stand by. All right, so during the mechanical trading forward, this was just a time when we were emphasizing mostly swing trading from about 2005 through 7, and this is representative of a long period of time. So 811 days in the test, 165 trades, 119 winners, 46 losers, so that's 0.72 win rate. The average win, 0.47, average loss, minus 0.37. The maximum winner we had was 1.44R. Biggest loser, minus 1.11. Gives us a 3.28 profit factor. System quality number of 4.79. Netted out almost 40R with a pretty tight standard deviation. So that's the channeling system. It's kind of bread and butter. In the rule set, we are trading it with just the 10 primary ETFs of the world market model. There's a lot of evidence that shows that it's a reasonable approach to trading large cap stocks and other liquid ETFs that have large caps in them or broad market sectors. So this is a relatively robust, simple rule set. Doesn't get any easier than this. Let me show you where on the daily report we find those signals. Standing by. So now when we look at our Tortoise daily report, we're on page 1, the cover page. This is as of February 14th, 2016, the date of recording. Page 2 is going to look at summarizing some market conditions and some key signals from the swings, and then we're also going to look at the Dow and the ETF 30 tactical. So the primary system, these are the channeling rules right here: greater than the 200-day moving average, Williams percent are greater than minus 80 or less than minus 80, buying another position if we're still in the trade, if the opening conditions or entry conditions meet, and then exit when Williams percent are greater than minus 30 at the close. And so in this case, there are no signals firing. Everything is on no and no. If the S&P had fired on both of those rules, these would turn green with the word yes, and then the symbol itself would light up. When we go to page 2 for the Dow, we would look in the channeling column. Any channeling signal that fires for any member of the Dow would give us a green light in here, and the same thing with ETF 30. Just so happens there's no signals today, but that's the places where we would find those signals. So a simple, robust system, and index channeling. That's the one that I normally recommend folks start with for swing trading because of its simplicity and its long-term robust performance. Keep your risk measured and your powder dry.